And exciting time here in the markets. We are seeing $100 silver. We just broke above it, and now I haven't checked the charts for the last 20 minutes, but your take on what's happening, David, with silver.
All right, everyone, welcome back to the channel. Really appreciate you being here today. So we've got David Morgan on this video, and he's reacting to silver breaking through the $100 barrier in real time. Something he actually predicted all the way back in 2003 when silver was sitting at just $5 an ounce. Now that we've finally reached this psychological milestone, he's making some pretty bold statements about where prices could head next. And more importantly, he's explaining why the fundamentals supporting silver today are exponentially stronger than when he made that original prediction 2 decades ago. This is the kind of conversation that could completely shift how you think about precious metals positioning. You're definitely going to want to stick around through the entire video because he drops some serious knowledge about portfolio strategy and what assets might actually outperform silver from these levels based on historical ratio analysis. And hey, drop a comment below and let me know where you're watching from. I love seeing this community grow and hearing from viewers all around the world. All right, let's jump straight into the video.
Everyone, so sorry for the delay there, having some technical difficulties with the live stream. If everyone can just make sure the video and audio is working in the chat, if you can let me know, that's great. And exciting time here in the markets. We are seeing $100 silver. We just broke above it, and now I haven't checked the charts for the last 20 minutes, but your take on what's happening, David, with silver.
Well, we're on a run. I mean, at the risk of repeating myself too many times, as you well know, I've said for years that 90% of the move comes in the last 10% of the time. I also, called out the run to gold way before the mainstream became aware of it. I talked about the run to gold start as like a light walk and a brisk walk and a light jog, full jog, fast jog, light run, and an all-out sprint. And we're probably in the fast jog right now, maybe in the light run, because things are accelerating. And this is the time when people make the most money in the shortest amount of time. I mean, the metals can be, I don't like to say this, but there are times, and they're rare, where you can get rich quick, so to speak. I mean, people that bought silver at the all-time high a few months back at 50 were paying the all-time high nominal price. And that's doubled in a matter of months. And there's not too many stocks that double that quickly. And so to answer your question, I've beat around the bush a bit, Elijah. I'll give it back to you. And that is, we are still in the price discovery mode. There's no doubt in my mind that until we get equilibrium in the physical market, which is running this price higher, the amount of commercial bars that are being demanded and the supply probably can meet that demand, that's to be determined. It hasn't met it yet. And because of that move of physical metal to basically the Shanghai and the Mumbai exchanges, we're going to continue to discover the true price of silver.
I think it's just such exciting times. Obviously, you've been projecting $100 silver for so long, and now we're here. I guess silver has met your price target here. So what do you think will happen from here? It seems like a lot of people are selling into this rally. I'm thinking it could be a topping soon. You just look back at where we've been in the last couple of years. Last year, silver was under $30, and now it's $100. So it seems like we've had quite a big move really, really fast, and that doesn't always end well. So what do you anticipate happening next?
That's a real tough one because obviously I'm biased in several ways, but I try to be as objective as I can. And so I really thought about that question recently, and I said, well, wait a minute. If I wrote that silver would be $100 in 2003, and at that time there was no silver ETF, there was really not that many online dealers. When you go back into those early days, Miles Franklin was around, but I don't think they had an online presence. SB Bullion, a lot of your competitors, there were just, but now they're all over the place. There wasn't much interest in silver, particularly, even gold that much back then. And so if I was able to put a price target with, let's say, not nearly as much exposure to the public and institutions back in 2003, and now we have, all kinds of places to buy it worldwide. We have the SLV, the PSLV, we have AI, data centers, more solar than ever, more electronic goodies than ever, and all of that. How would I factor that in to that $100 level? Well, none of that stuff existed. So I'm trying to set the foundation. So looking into that and trying to sit here and be objective, it's really tough for me to put a price. So I'm not going to. What I am going to say is that if I was confident it would be $100 silver without all those things I just outlined, and you might want to add some more, Elijah, obviously it's pretty logical to say it could go higher than that.
So silver just broke $100, and this is the moment that changes everything. When the host opened with that line about exciting times in the markets and silver breaking above $100, he wasn't exaggerating. This is a psychological barrier that the precious metals community has been waiting years to see shattered. And what's wild is that as of January 2025, we're watching this play out in real time, with silver trading in the high double digits, approaching that triple-digit threshold that seemed impossible just a few years ago. Now, David Morgan drops this absolutely critical insight when he said, 90% of the move comes in the last 10% of the time. And if you understand market psychology and momentum trading, you know this is how parabolic moves work. Think back to 2011 when silver went from $18 to $49 in less than a year. The majority of that move happened in the final few months. The same pattern played out in 1980 when silver went from $6 to $50 in 12 months. The acceleration phase is where generational wealth gets made, but it's also where most retail traders get shaken out because the volatility is intense. But here's what really caught my attention. David mentioned he predicted $100 silver back in 2003. Let me put that in perspective. In 2003, silver was trading around $5 an ounce. There were no silver ETFs, no massive online bullion dealer networks, no AI data centers consuming industrial silver, no massive solar panel buildouts. The fundamentals supporting silver today versus 2003 are exponentially stronger. We're talking about electric vehicles requiring 25 to 50 grams of silver per car, 5G infrastructure needing silver for every cell tower, solar panels using 20 grams per panel, and global solar installations hit record levels in 2024, with over 400 gigawatts added. So when David said, if I was confident it would be $100 silver without all those things I just outlined, you might want to add some more, he's essentially telling you that his original thesis has been amplified by technological demand that didn't exist when he made that call. The industrial demand picture for silver in 2025 is fundamentally different than it was in 2003. We're not just talking about monetary demand or investment demand anymore. We're talking about structural industrial demand that cannot be substituted. You can't build an EV without silver. You can't build a solar panel without silver. The supply deficit that analysts are projecting for 2025 is estimated around 200 million ounces. That's massive when you consider total annual mine production is only around 830 million ounces globally.
As we're speaking, I was just looking at the chart. It's about 101 right now. So it seems like we're blasting through this level. Do you think that $100 is even going to be much of resistance here?
I do. I just put out a update for members only yesterday, and I said, and I may be right or wrong, that I thought psychologically it's triple-digit silver. I've still got the T-shirt. I should have worn it today from Keith Newmeyer, triple-digit silver. And I probably said $100 before him, but it's not a race. I don't really care. But he was nice enough to give me one. Point being is that I think those round numbers in all commodities, be it corn, wheat, soybean oil, doesn't matter. There's a there's times. And I think it will be that way with silver. I think that the powers that be or the powers that shouldn't be may fiddle around that price level and maybe, let it run to whatever it does and then take it under 100 for, I don't know, days, maybe a week or two, three, I don't know, just to kind of put in that psychology of, really doesn't belong much above 100, or the idea, as you just said, well, 100's it. Well, even Morgan said 100 was that's never said that was it. I said it would get there, and as I just said, I think it's going higher than that. But so I do. And now I could be wrong. I mean, Michael Oliver, who I know you've had on a lot, and great respect to him and Rafi, and a lot of people that are, I wouldn't say new to the field. I think Michael Oliver has been doing this as long or longer than just lots of good thinkers out there and they all have kind of a specialty within us. Point being is it could just rip right through it and keep going. I don't know. But I actually think, as I said, psychologically, if you want to manage this market, which has been done for decades, and now it looks like those entities have lost control for the most part, they might still do a last stand type of thing. So I don't want to belabor it, but that's what I'm looking at. Whether it takes place, we'll find out.
A lot of people have been looking at ratios right now, the gold silver ratio. Today, obviously, below 50 to 1, breaking below that again. And you also have the silver platinum silver ratio at extreme lows. As you've mentioned, also the silver oil ratio, very dramatically oil underpriced compared to silver. If people are looking to, I guess, take some profits or transition into other assets, what are you looking at right now? And do you think right now might be a good time to at least start doing that?
All right, so now we're getting into the real conversation about what happens at $100. David said, I thought psychologically it's triple-digit silver. And he's absolutely right about the psychological impact of round numbers in commodity markets. We saw this with gold at $2,000. It hit that level multiple times before finally breaking through and staying above it. The same thing happened with oil at $100 per barrel. These round number resistance levels exist because of human psychology, not fundamental analysis. But here's what makes this moment different. When David said, I never said that was it, I said it would get there, and I think it's going higher than that. He's pushing back against the narrative that $100 is some kind of ceiling. And if you look at the inflation-adjusted all-time high for silver from 1980, we're talking about $150 to $160 in today's dollars, depending on which inflation calculator you use. So $100 silver isn't even back to the previous peak when you account for monetary debasement over the last 45 years. Now, this next point is crucial. David mentioned, if you want to manage this market, which has been done for decades, and now looks like those entities have lost control for the most part. He's talking about the paper silver market and the entities that have historically suppressed price through derivatives and futures manipulation. And here's what the data shows. COMEX registered silver inventories have been declining dramatically over the past few years. As of late 2024, registered silver at COMEX was sitting around 40 to 50 million ounces, while open interest represents claims on hundreds of millions of ounces. That's a leverage ratio that becomes extremely dangerous when physical delivery demand surges. The Shanghai Gold Exchange and the Mumbai precious metals markets are now creating price discovery outside of Western paper markets. When you have a $10 plus premium in Asia over Western spot prices, that's not just arbitrage. That's a fundamental breakdown in the traditional pricing mechanism. Physical metal is flowing east because that's where the demand is, and Western vaults are being drained. This is the exact setup that precedes major price dislocations. The paper market can suppress price through leverage, but only until physical inventory reaches critically low levels. And we're approaching that inflection point right now in early 2025.
I think so. I mean, thank you for paying so much attention to my work. I appreciate it. I don't want anyone to take their profits and put it in fiat unless that's what they want or need, pay off bills or pay off their house, whatever they decide, it's their money. But if you want to reinvest the proceeds, let's say you sell at $100 silver and you put it into three really good oil stocks that pay like 4 to 7% dividends, and silver goes to $200. You could go, oh my goodness, what did I do? Silver doubled from here. But what if that oil company went from X to 3X? You've actually made more profit by diversifying out of silver into oil. Now, I'm not saying that's going to happen, but that's a thought. So let me give it a little more succinctly. The only thing that I think should be done at this point is find, as Mike Maloney has said many times and others, that you really don't want to think too much about the price in paper of what silver or gold is. You want to value it relative to how much silver does it take to buy the Dow? How much silver does it take to buy a house? How much silver does it take to buy a barrel of oil? Well, it's very, very to the oil ratio, which means that's a good buy with silver right now. So there's a place you could diversify. Same thing with platinum. Platinum, although it's to silver so far, relative to the price of silver, you're buying platinum really cheap if you buy it with silver. So those are two places, really kind of the only two that I'm very adamant about right now. And again, I put a guidance for my members on how to sell into this rally and, what the price targets could be, but it's always an individual choice. And I can't give the right answer for everybody because everybody's got different motivations, different age, different, different goals, but I can give some guidance. And one thing I think I've emphasized in the last two updates I've done is, and I have to take a deep breath, in the unlikely event that we truly go into a hyperinflationary situation, you want to have some metal all the way through. Because as you and I both know, I know you're a student of monetary history as well, the only thing that survives in a complete currency fundamentals. I mean, land does and real estate, and if you have a lumber yard fully paid for, yes. But as far as liquidity and acceptance, transitioning, as Rafi Farber would say, through the end game, if it gets to the point where we don't trust the currency, the U.S. really wants metal. So I would suggest it to everyone that determine what you need for 3 to 6 months living expenses in metal and hold on that amount as a minimum all the way until we know that things have gone into that kind of a situation or we have transitioned into the new system.
And probably best for that kind of situation of having something on hand in case we would need to use it, in my opinion, would be junk silver, which is...
Now we're getting into portfolio strategy, and this is where David's experience really shines through. He's talking about diversification out of silver at these elevated levels, and he brings up the oil to silver ratio and the platinum to silver ratio. And this is smart tactical thinking. When he said, how much silver does it take to buy the Dow? How much silver does it take to buy a house? How much silver does it take to buy a barrel of oil? He's framing wealth in terms of relative value, not nominal dollar prices. Here's why this matters. If silver is at $100 and oil is at $70, that's a ratio of about 1.4 barrels of oil per ounce of silver. Historically, that ratio has averaged closer to 3 to 5 barrels per ounce. So David's point is that you could sell silver at these levels, buy undervalued oil stocks paying 4 to 7% dividends, and potentially capture more upside if oil mean reverts to its historical relationship with silver. Same logic applies to platinum. If platinum is trading at $950 and silver is at $100, you're getting platinum at less than 10 to 1 ratio. Historically, platinum has traded anywhere from 15 to 1 to 40 to 1 against silver. So you're essentially buying platinum at a massive discount using silver. But then David pivots to something really important. He said, in the unlikely event that we truly go into a hyperinflationary situation, And this is the core thesis that every precious metals investor needs to understand. We're not just talking about 5% inflation or even 10% inflation. We're talking about currency destruction scenarios like Weimar Germany, Zimbabwe, Argentina, Venezuela. In those situations, the only assets that maintain purchasing power are hard assets, real estate, commodities, and especially precious metals. And his recommendation is incredibly practical. He said, determine what you need for 3 to 6 months living expenses in metal and hold on that amount as a minimum. This isn't about speculation or trying to time the top. This is about insurance. If we enter a currency crisis where the dollar loses confidence, you need physical metal that you can exchange for goods and services. Not paper silver ETFs, not mining stocks, physical metal in your possession. And he's specifically talking about constitutional silver, pre-1965 US coins, because they're recognizable, divisible, and have no counterparty risk. Looking at where we are in January 2025, the macroeconomic setup is screaming for precious metals. US national debt is over $36 trillion and climbing. The Fed is trapped between fighting inflation and preventing recession. BRICS nations are actively working on alternatives to dollar-based settlement systems. Central banks bought over 1,000 tons of gold in 2024, the highest annual total since 1967. The de-dollarization trend is real, and it's accelerating. And silver, being both a monetary metal and an industrial metal, is positioned to benefit from both the monetary debasement trade and the green energy technology build-out. That's a dual demand driver that gold doesn't have. So when David made that $100 prediction back in 2003, he was looking at monetary factors. Today, you have monetary factors plus structural industrial demand plus supply constraints. That's why his thesis is actually stronger now than it was 22 years ago. So what do you guys think of this? Leave your thoughts down in the comments. Please like and subscribe, and I will see you in the next video.